Welcome to Pressure Points. Our topic is Amazon earnings. And as of this recording, which is about 30 minutes after the market or the conference call ended, shares of Amazon are up just over 13%. That's more or less where they were at when the conference call started. The stock kind of drifted 1-2% higher during the earnings call, but overall, just a very positive reaction. And I'm going to quick jump into why that was the reaction and then get to the pressure point. The reason the reaction was, I think, twofold. Number one, the AWS number, of course, that was the focus. The Whisper number was 18.5% growth. That was a step up from around 17.5% in the June quarter, and they did 20% growth. So a lot of focus on AWS. They delivered on that. But also, if you look at the guide, is that they typically come in at the high end of their range, above the high end of their range. And for the December guide, the revenue was implied, if you take the high end, to be about 3% higher than the street. And the operating profit is about 9% higher than the street. 3% beat on revenue, 9% beat on earnings. That is a positive sign, which gets me to the pressure point, which I believe is this is a margin expansion story, in part because of automation, in part because of AI at the workforce, which I guess is a form of automation. But there is no denying it. This company has seen some impressive improvements in margins over the past 5 years. And to put that into perspective, to put the margin improvements into perspective, let's look at the December guidance again. Is that if you take the view that they come in at the high end of their range, which I think is a reasonable view, they're going to have operating margin of about just over 12%, 12.2%. Now that compares to last December, I think it was around 11.7%. So a nice little step up from there, and improvements all the way back from 2019, before the pandemic, it was about 4.5%. So we've seen this steady improvement, in particular over the past 2 years, in terms of margin expansion. And I highlight that as a pressure point. I know that's not going to be a typical takeaway, but Amazon is such a big company that any little changes to margin can have a meaningful impact on their earnings and have a meaningful impact on, therefore, on valuation. And so the degree that they can keep moving that margin higher, I think, is going to have a big impact on how the stock performs in the years to come. Now, one kind of sub story to the margin improvement is around AI and automation. Of course, Amazon recently had a round of layoffs. The topic came up on the conference call, and CEO Jassy said that he really sees AI and automation as complementing humans. And this is, I think, an underappreciated part about the hard reality of, or an under talked about part about the difficult reality of the whole AI conversation, which is management's commentary is largely around this being complementary. I think the reality is that machines are taking people's roles away. And I think that you're seeing companies have margin expansion because of it. And they talked about having 1 million robots now. Undoubtedly, that number is going to continue to increase. And so just to finish the thought on the pressure point is that they showed strong margin guidance. And I think we'll continue to see that as Amazon continues to embrace robotics and automation throughout their massive 1 million+ workforce. Moving on, this next topic, just in terms of AWS, mentioned 20% growth versus the Whisper 18.5%. That, of course, was supply constrained, as has been over the past several quarters. So that number would have been higher. And the fact that it was supply constrained suggests that in the December quarter, we're going to see another acceleration in growth. My guess is the street's going to probably come out to 21% growth, up from 20% in September, as far as the expectations for the December quarter. But AWS in a good place. As part of this, kind of the strength of AWS, they mentioned on the call that the backlog is now greater than their revenue. I assume they're referring to their Q3 revenue. That comment was made in a very bullish context, but there's really not a ton we can draw from it, because we don't know what the duration of them recognizing that backlog. That could be over 1 quarter or several years. And so hard to really kind of fill in the blanks beyond they have a growing backlog, which in some respects is to be expected. Last topic in terms of CapEx for calendar 25, they gave guidance that was essentially a 6% increase in CapEx, and they did not give a 2026 outlook, but they said that it would be increasing from that 2025 level. To put Amazon into perspective versus some of the other hyperscalers, for calendar 25, they're going to be at like 125-ish billion in CapEx, and that compares to, if you look at Microsoft and Meta and Google, they're kind of in that 70-80 billion dollar kind of rough range, and all three of those other ones are going to be in the well over $100 billion for next year. So if you take that kind of similar view, is that Amazon had called 125 billion in CapEx for calendar 25. My guess is it ends up being up something like 25-30% next year. The street is looking for more like 13% growth. So I think those numbers still need to go meaningfully higher. We'll see some of those changes tomorrow. Why is that important? Continue to invest in AI, continues to kind of make AWS a more bold, a more attractive product, which is good, obviously, for an important segment. And it can help also as they pursue more automation. And the kind of that last piece around how this CapEx all plays together is, don't forget all this talk we had yesterday from the three companies that reported and Amazon tonight. This is all good news for Nvidia. How about that for bearing the lead? On behalf of Pressure Points, bye for now.